Hello, my name is Jason Bidiger, and I am part owner of Anchor Insurance and Financial Services along with Teresa Bilton. We are an agency in Little River, South Carolina, and if you want to jot down our information, it is right there on the screen for you. What we're going to do with this slideshow is go over life insurance basics. Now, by basics, we mean how do you pick the right amount of life insurance for your family? And not only that, what kind of life insurance? Because there are, a handful of different kinds that you can choose from. So it comes down to your want versus your need versus what you can afford is the simplest way to put it. Now we're going to break everything up into two sections here. We're going to have a want section and a need section. And we're going to use the acronym LIFE, which stands for loans, income, funeral, and education. Almost everything you do can be grouped into those four subjects right there, those four categories. And to show you that, we'll start with loans. So in the want column, these are things that you want for your life insurance. If money was not an object, you're going to want to cover all of your loans. So you're going to want to get out of medical debt, auto loans, mortgages, credit card debt, all of your debt you're going to want paid off. And some of those things you might not have at the moment, but they will come to fruition if you happen to pass in a sudden sort of way. You're going to end up with medical bills most likely because the doctors were trying to save you. Let's say you don't have an auto loan right now, but you're going to be looking in the next year or so. Well, your family is going to get an auto loan, so you might want to look forward a little bit and use that as a want. If you're going to put that in the policy, then if money's not really an object for you on your life insurance, you want to make sure everything's covered, you might want to think ahead like that. Now, income recommended is 3 times the loss of a salary. Now, that can be a little bit misleading because you're also going to have to think about if a stay-at-home spouse happens to pass. What is the income that you're going to be having the new outgoing amount that you're going to have to look at coming out of pocket. So now you're going to need a new sitter for the kids. You might have daycare costs that suddenly are there you didn't have before. You might have house cleaning costs or landscaping costs or these kind of things that you didn't have in the past that are now new bills that you're going to want to think about. So it's not just salary that it's going to come into your thought process there. Funerals, we have an average cost around here about $12,000 for burial, about $2,000 for cremation. Now you can get cremations for as low as $500 if you want to put it in there. Funerals, I've seen them up to $30,000. So it just kind of depends there. Education, you're going to want about $60,000 per kid on average is what we suggest. And the reason we come to that is even if your kid doesn't go to college, let's say they go to a tech school or get a trade, you're not going to be dishing out that full 60,000, but they're going to need something to go into the world with where they have a heads up on some other kids. Perhaps when they're 20 years old, 22 years old, you're not going to want them to lag behind. You're going to want them to either have an education or a career kind of in line, or at minimum enough to put a down payment on a house. If they're working their ways up at maybe Walmart or something, and they become a manager, and that's just their dream. They just want to keep working up the ladder. You got to give them some funds to start their life the right way, to enter adulthood without as much stress. Now, when we go into need for loans is a little bit different. You're just going to want to pay down your loans enough that your loved ones can continue the payments on. So basically, you're going to have to sit down with your loved ones and go over what the budget's going to be like if you're not there anymore, and find out what that number is, and then find out how to cut down your loans to a good amount. Definitely a high interest loan like credit cards, you're going to want to pay those off. Other things like mortgages or medical bills, you might be able to, medical bills usually are $0 loans, really, is what they are. mortgages usually have a small percentage rate, but they do add up over the years and years and years. You might want to refinance, put in there enough that they can at least slim their $1,000 mortgage down to $500 a month, and that would really help out your family when they're losing your income. So income works the same way, really. We're talking about that lost income when it comes to loans. You have to look at it the same way as the want field, where you're going to have added bills put on there that you're not thinking of, like landscaping costs or house cleaning costs. You're going to be eating out more probably because you don't have time to cook as much in a single parent household. So these are all things that you're going to need to be thinking about, and you're going to need to come to a number where maybe your spouse is looking at a raise in a year or two, something to just supplement them, to get them by, to get them on their feet while they're going through their readjustment period of the new bills and figuring out how to live their new life, really. Funeral costs, it's a need. The want and the need are the same on this. You want that average cost is there, and you want to pay for that. So that's the same. Education-wise, I would say a need is about $10,000 per kid. And again, the same thinking. Education-wise, you're going to need something there for your kids to get a leg up. You're going to want them to have money to start their college education or to get a trade, tech school, anything like that. Anything that can give your kids a heads up in the world when they're 20, 22 years old, where they're not falling behind with nothing. That $10,000 can help a lot. So that is something that we consider a need here, and hopefully you do also. Now we're going to get into a scenario for a want and a need and show you the differences a little bit more in detail. So for want, we're going to come up with our loan amount. You have $150,000 for your home, $20,000 for auto, and let's say you have $5,000 in medical because that was your out-of-pocket max for your health insurance that you have, and they tried to do everything they could to save your life, and now you have a new bill. So let's put all those together, $175,000, easy math. Now your income, you have $40,000, 3-year salary is usually what we say we would want. Comes to $120,000. Funeral costs, we're going to go with a burial average rate about $12,000 here. And next on the list would be your education. You got $60,000. You got 2 kids, it's coming to $120,000. Then we're going to go ahead and just do the easy math and put them all together. It's $427,000 is what you're going to want your family to have if you were to pass. And so in the insurance world, that means you're looking at a policy between $400,000 and $500,000, depending on your circumstance. So it depends on your budget, really, and depends on what kind of policy you feel is the best fit for you. And when we team it with your pocketbook. So depending on those things, and then we're going to look also at banding. Insurance policies are rated different depending on the number of units you have. So a policy that's $450,000, you hit that next banding level up, $500,000, you might be looking at the same price, or $2 a month more for that policy, because the rate for each unit of a life insurance policy goes down for some companies at $500,000. So each of them has a different level, and that's where the insurance professional, you're going to talk to them, and we can rate that out, switch it with different companies, because we know these kind of things, these details, to help you out to make sure you get the best policy that you can get for your buck. Well, the next scenario we're going to look at is a little more difficult. This is the need scenario. This is where we got to put a little bit more thought into it. So we got the same numbers here for your home loan. Let's say $150,000, auto $20,000, medical $5,000. But we're going to come to $110,000 that we're going to put as a need, and I'm going to show you how we get to that number. The home, we're going to look at $150,000. We're going to pay it down to $60,000, let's say, and refinance at $60,000 just to get that payment really low as we can get it. So we're going to take $90,000 off of that loan right there, and we're going to pay the auto off all also, which is another $20,000. So that's where we get the $110,000. The medical bills, $5,000. That's really, you can look at that as a zero interest loan for somebody that's in a pinch. They're gonna hound you about it, but as long as you're sending them, 20, 40 bucks a month, as long as you're making an effort, they will usually work with you and won't give you any interest on that. So that's why we say 110,000. Your income coming in at 40,000, we're going to do 1 year's salary instead of the 3 years that we usually recommend. So again, this is a need. We're looking out for your pocketbook. So what that 40,000 is going to do over the next year is going to give you time to adjust. So it's going to give you time to adjust to the new bills that are going to come in when you're missing your spouse. One of you, both of you, usually do a good amount of work that now you might need to pay somebody to do, or like I mentioned before, you might be able to do it all on your own, but now you're going to be eating out more because you just don't have time to cook. Like, things are going to need to be sacrificed and adjusted to, and so that 40,000 is going to help with that, especially bringing in that added money with the mortgage being dropped, no car payment, that kind of thing. Hopefully that you can lag that out for another year or two. In this scenario, we're going to do a need. We're going to do cremation on this time. So we're going to put it at $2,000 for the cremation. Again, just an average cost we're kind of throwing out there for that. And then we're going to come to education, and same rule. You got the $10,000 that we consider a need. You got 2 kids. We're going to put that as $20,000 then. So then we're going to add all that up, and your total need is $172,000. So what that means in life insurance terms is that you're going to be looking at about $175,000 to $250,000, again, depending on your circumstance. So that's what your face value should be if you're looking at just the needs to make sure that your family is well taken care of after you pass. And that depends on your budget. And it also depends on the banding. Again, $250,000 is usually one of those numbers that life insurance professionals know about. Certain companies, they will drop the per unit rate on a life insurance policy. So I've seen it before where a policy, they'll come to $225,000 and we'll go to $250,000 and the price will actually be lower than the $225,000 policy. So that's something that, again, a life insurance professional knows these little things to get the most bang for your buck and help you out there. And now we're going to go over the basic types of life insurance policies that we like to use here at our office. And it's always good to talk to a professional when it comes to these because you can combine things. Sometimes it's good to go with a little term, a little whole, things like that. So the first thing that we're going to go over is a term life. Now, term life is the cheapest kind of life insurance that you can get, and that also makes it the most popular kind of life insurance you can get. So we definitely do the most business in term life, and basically what it is it's a life insurance policy that goes for a certain term. It could be 10, 20, 30 years. You can kind of pick the term that you would like. Some people like to attach it to a mortgage, things like that. But then the basics of it is that it goes away after that term is up. Now, you can convert that into a whole life with some companies. Sometimes you can renew the term with a little or no medical, depends on the company, but that rate will go up. So that rate that you got when you were 20 years old and got a 30-year term is going to be much higher when you renew it at 50 years old because it'll give you the 50-year-old price. So that's the basics of a term life. It either goes away or becomes much more expensive when you renew. The other kind of term that we like is a return of premium term. And basically that's a term policy with a rider on it. And that rider makes it so that any premium that you put into this policy, you will get back at the end of the policy. So let's say you do a 20-year, 30-year term, and you're putting $20 a month into this policy. At the end of 20 years, 30 years, 2 things will happen. Either you pass in between that time and your family gets that face value, or at the end you get all that money back. That $20 a month that you've been paying, you get it back. So it's a win-win there. You're not losing out on any money. I know if it's kind of like a zero interest savings account, so not bad. Now I know in financial terms it's you're not gaining any interest over the 20, 30 years. So, financial advisors will tell you that you're losing money, but this is a pretty good deal for that little bit of extra that you'll be paying on top of term life to get all that back. Now, a whole life insurance policy is a policy that you can put into play. Usually we sell these a lot for younger people. It's big in juvenile life and such. It's also big for final expense policies at the end of life. But this is it's a pricier policy, but it grows with you. So the older you get, the more money you're putting into it, it can actually build up funds within it. So you can take loans out against it in the future, and it's guaranteed to never go up in rate. So if you sign on and it's $25 a month, 40 years later, 50, 60 years later, it's still going to be $25 a month. So it does have its positives, but like I said, it is a little bit pricier. So we try to do this for younger individuals. Now, another type of life insurance policy is one that we don't like to. I'm not going to get into too much detail right now on it, and I'll tell you why. It's a mixed bag kind of a policy. It's complicated. It's you can set it up so it's like a whole life. You can put it in guaranteed till a certain number of years. But if you don't have that guarantee on it, then you're going to need it checked up on every year, I would say, just to make sure it's getting funded correctly. It does give you other options, things you can put on that like long-term care, things like that. So it does have some stuff to it, but talk to your life insurance professional and they will guide you through this a lot more in detail so that you know what you're getting into, if that's an option that you feel would be best for you. But again, your life insurance professional will definitely let you know if they think that's the best thing for you. And I just want to thank you for your time. It includes everything today. I hope that you learned. I know that was a little bit long, but hopefully it could have been way more detailed, but hopefully you got enough out of it. And if you have any questions or want to set up a life insurance appointment with us, here's our phone number, our address is there, and a link to our website. So we hope to hear from you. Thank you.